Coming soon, a structured exit capital solution built specifically for small businesses. And if that sounds abstract, let's make it painfully concrete. In the lower middle market, a huge number of businesses that go up for sale just don't sell. Not because they're bad companies, not because nobody's interested, but because the deal machine breaks down at the exact moment it needs to work.
You're talking about that stat everybody hates hearing, right? The one that says most deals never close.
Exactly. Roughly 80% of small businesses brought to market don't close. 8 out of 10 owners go through the emotional roller coaster of, I'm finally going to exit, only to end up back where they started, still owning it, still working it, and now wondering if they'll ever get out.
And that's not just inconvenient. For a lot of owners, that business is their retirement plan.
More than that, often it's their net worth. In many cases, around 90% of an owner's wealth is tied up in the company. So when a deal fails, it's not just a failed transaction. It's years, sometimes decades, of value that can't be realized.
Plus, small businesses are kind of the whole economy in a lot of ways.
Half the U.S. workforce is employed by small businesses. So if exits are broken at scale, it impacts jobs, local communities, suppliers, everything. Here's the frustrating part. Many of these companies have what buyers claim they want: stable operations, loyal customers, defensible niches, reliable EBITDA. They're not story stocks. They're cash flow machines.
Then why do they trade at those low multiples? You always hear 2 to 3 times cash flow and it just feels small.
That's the symptom. Typical small business transactions often land around 2 to 3 times cash flow. And a big reason is the same reason deals fail. The buyer pool is too small and too fragile. The market keeps saying it's a valuation disagreement. But that's not the real problem. The real problem is structural.
Okay, define structural, because people use that word when they don't want to explain the actual issue.
Fair. Here's the issue in plain terms. In this asset class, many businesses are owner-operated. That's not a flaw. It's how the lower middle market works. The owner is the manager, the relationship hub, the decision engine. They know the customers, they know the staff, they know the weird little operational details that keep the wheels from falling off.
So you're saying the business isn't just a set of financial statements. It's also the person.
Right. And that creates a hard requirement for the buyer. It's not enough to have money. The buyer has to be able to take over that owner-operator role immediately after close. Because if they can't, the earnings profile that justified the purchase price can evaporate fast.
Which means the buyer needs 2 things at once: capital and operational readiness.
Bingo! But the market tends to treat those as separate. You might find someone with money who can't run it, or you find a killer operator who could run it, but can't fund it. And even when you find the right person, the process often lacks a reliable way to qualify them properly and get the capital structured cleanly.
So the world is full of interested buyers, but not enough qualified, funded buyers.
That's the heart of it. It's not a lack of interest. It's a lack of infrastructure. There hasn't been a repeatable system to identify a capable operator, verify they can actually do the job, and fund them with terms that make the transaction executable. So deals fail. And when deals fail, the market learns that small businesses deserve discounted valuations. It becomes self-fulfilling.
Let me push you on this. People will say, just get an SBA loan, or just put it with a broker, or just do seller financing. What's different here?
Great question, because those tools exist, but they don't solve the execution gap by themselves. Traditional financing is often the number one deal killer in this segment. Appraisals, underwriting timelines, changing requirements, last-minute retrades. It introduces contingencies that blow up transactions late in the game. Meanwhile, basic seller financing without a real structure can turn into a handshake note that nobody knows how to manage or enforce.
So the missing piece is structure.
Structure and full-stack execution. The solution that's coming is built around seller-financed acquisition lending. Loans are designed so qualified operators can buy businesses they're capable of running, even when they don't have all the cash up front. But the key word is qualified. This isn't anyone with a dream gets a loan. It starts with underwriting that treats operational readiness as seriously as financial strength.
Walk me through what operational readiness actually means in practice. Because that could be vague, too.
Think about what the owner actually does. They manage the team. They handle customer relationships. They make pricing calls. They put out fires. They know the seasonality, the supplier quirks, the key metrics, the risks. Operational underwriting asks, can this buyer realistically take the baton at close and keep cash flow stable? Do they have relevant experience? Do they understand the business model? Do they have a credible plan for the first 90 days? Are they stepping into the relationship seat, not just the ownership seat?
That's huge, because when deals go wrong post-close, it's often because the new owner didn't know what they were walking into.
Exactly. And sellers know this. In their gut, they know it. Many owners would rather not sell than sell to someone who will run it into the ground, especially when their name, legacy, employees, and sometimes their earnout or note payments are on the line.
So this approach is also seller-friendly, not just buyer-friendly.
It should be. For the seller, a structured lending mechanism expands a buyer pool because it capitalizes operators who otherwise couldn't close. It also reduces the execution risk because you're not waiting on a traditional financing process that can collapse late. And when you combine that with real underwriting, sellers can support valuations that reflect actual cash flow instead of accepting a discount just because the business is owner-operated.
Okay, but let's get specific. What are the components of the solution? Like, what does transaction infrastructure actually include?
It's a full system, not a loose set of services. First, buyer underwriting and qualification. Clear criteria, both financial and operational. Second, seller finance loan structuring. That means designing the capital stack to bridge the buyer's funding gap, while defining repayment terms and exit terms in a way that's explicit and enforceable.
So not we'll figure it out later, but actual terms that can survive real life.
Yes. Third, post-close loan administration. This is a big one that people ignore. If you're going to use seller finance lending at scale, you need active administration, payment processing, covenant tracking, ongoing compliance, handling issues early, and protecting the value of the note over time.
That's the difference between a note that's a real asset and a note that's a stress headache.
Exactly. Fourth, legal and compliance architecture. The small business market is often full of ambiguity, templates, informal promises, unclear remedies. A defined legal framework brings clarity, certainty, and enforceability. And then fifth, structured asset pooling.
That one sounds more institutional. What does it mean here?
It means loans can be structured to standards that make them eligible to be pooled into portfolios. When you can pool qualifying notes, you open the door to more scalable capital. And when capital becomes more consistent, the whole market functions better. More closes, fewer broken deals, valuations that better match fundamentals.
So you're not just solving one deal at a time. You're trying to fix the plumbing.
That's a great way to put it. The businesses aren't necessarily the problem. The process is. This is about building the plumbing, a repeatable way to match capable operators with the capital and structure required to close.
Let's talk about the pain point again, because I want listeners to feel it. You've got an owner. Their business is stable. Customers are there. EBITDA is real. But it's owner-led. They go to market. And then what happens?
They get tire kickers. Or they get buyers who like the idea but can't fund it. Or they get funded buyers who want to hire a manager to replace the owner and it's not credible. Then the due diligence process drags. Financing becomes the bottleneck. The buyer retrades. Or the lender changes terms. Or time kills momentum. And eventually, the deal collapses. And the owner hears, that's just how it goes.
Which is wild when you realize how much depends on these exits working.
Totally. The conclusion basically writes itself. This isn't a rare edge case. It's systemic, profitable, well-run businesses fail to transact at scale, not because they're unattractive, but because the market doesn't reliably create a buyer who is both funded and ready to operate.
And that's why valuations get suppressed. Because the price isn't just about earnings, it's about certainty of closing.
Yes, the market price reflects execution probability as much as it reflects fundamentals. Increase certainty, and you can support pricing that aligns with true cash flow.
So if someone's listening and they're a business owner thinking about selling in the next, say, 1 to 5 years, what's the practical takeaway?
First, recognize what kind of asset you have. If you're owner-operated, that doesn't make your business lesser. It means any good exit plan must include an operator transition plan. Second, understand that the buyer you actually need is not just a checkbook. It's a successor operator. And third, expect the winning outcome to come from a disciplined process. Not hope, not luck, not a last-minute scramble for financing.
And if they're a potential buyer listening, an operator who's confident they can run a business, but they've been blocked by funding?
Then the message is, you're not alone. The market is full of people exactly like you. The opportunity is real, and what's been missing is a mechanism that evaluates you as an operator and structures the capital, so you can close without the deal dying on contingencies.
All right, so big picture. What's coming is a structured exit capital solution for small businesses, built on seller-financed acquisition lending, with rigorous buyer qualification, real legal structure, and ongoing administration, plus the ability to scale through institutional-style pooling.
That's it. A strong business at exit still needs disciplined execution. This is about delivering that execution infrastructure: underwriting, capital structuring, legal documentation, and post-close administration, done in a repeatable way with clear terms and fewer surprises.
And maybe, finally, closing more than 2 out of 10 deals.
That's the goal. Hang tight. If this market gets the infrastructure it's been missing, it changes everything. Owners get real exits, buyers get real paths to ownership, employees get continuity, and communities keep the businesses they rely on. The small business market revolution might sound dramatic, but honestly, it's overdue.